Next, let's move on to eliminate intra-group balances and transactions. Imagine this: if Department A of a company sold $100,000 of goods to Department B of the same company, will that sales appear in the company's income statement? No, because it is an internal transaction. Then let's say Department B owed Department A $100,000 because it hasn't paid for the sales. Can we recognize an additional trade receivables and trade payables of $100,000 in the company's balance sheet? No, because it is an internal transaction where one department owes another department of the same company. The same logic applies here. In the group financial statement, any transactions between companies of the same group is regarded as an internal transaction and should not appear in the group financial statement. As I told you previously, the consolidation worksheet will by default add everything line by line. So if any line items include transactions with another company in the same group, we have to eliminate them and ensure they don't get added. Let's cover the sale of non-current assets from one company to another company in the same group. The general rule of thumb is we want to undo that sale of non-current asset in the financial statements. What does this involve? First, undo the gain or loss on the sale of non-current asset recognized by the company selling the non-current asset. Second, revert the cost of non-current asset back to the original cost. The company buying the asset will record it at the cost of purchase, which is usually different from the original cost. And if the buyer records the cost at an amount different from the original cost, the depreciation expense and accumulated depreciation will be different. In the group financial statement, the depreciation expense should be recorded based on the amount the seller will record. Let's go through how this works. In this example, the holding company bought a non-current asset worth $100,000 in year 1. It depreciates the non-current asset over 10 years. At the start of year 7, the holding company sold the non-current assets to its subsidiary at $50,000. The subsidiary company continued depreciating the non-current asset over the remaining useful life, meaning over 4 years, since the holding company has used the non-current asset for 6 years. Before I tell you the consolidation journal entries for this transaction, let's consider what each individual company will record in year 7 when the sales is made. In year 7, the accumulated depreciation recorded by the holding company is $60,000. So the holding company will debit cash $50,000, debit accumulated depreciation $60,000, credit non-current assets $100,000, and credit sale of non-current asset $10,000 to record the sale of non-current asset. On the subsidiary side, it will debit non-current asset and credit cash to record the purchase of non-current asset. If we combine the effect of these two transactions together, you will notice that the accumulated depreciation has decreased by $60,000. A gain of sale of non-current asset of $10,000 is recognized, and the cost of non-current assets has decreased by $50,000. In the group financial statement, we must record the non-current asset at its original cost, as though the sales did not take place. Please remember that this is because such sales is regarded as an internal transfer between companies of the same group. You cannot just recognize a gain on sale or change the cost of the asset by transferring the asset to another company of the same group. So to undo the effect of the sale, we will enter the consolidation journal entry, which is the reverse of the net journal entry entered. Debit sale of non-current asset $10,000. Debit non-current asset $50,000, and credit accumulated depreciation $60,000. When we debit sale of non-current asset, we are undoing the gain on sale of non-current asset. And when we debit non-current asset, we are reverting the cost of non-current asset back to the original cost that the holding company purchased at. This consolidation journal entry will be entered for subsequent years as well, as long as the non-current asset remain within the group of companies. Just note, however, that we will debit retained earnings for subsequent years instead of sale of non-current asset because no gain on sale is recognized for subsequent years. If we debit sale of non-current asset, we will be decreasing the profit unnecessarily. Also, the gain on sale recognized at the time of sale would have entered retained earnings, so we should debit retained earnings to undo the sale of non-current assets for subsequent years. Next, we need to adjust for depreciation expense and accumulated depreciation. The holding company purchased the asset at $100,000 and depreciated it over 10 years. That's $10,000 depreciation expense annually. The subsidiary company purchased it at $50,000 and the remaining useful life is 4 years, since the holding company has used it for 6 years. The subsidiary company would charge $12,500 depreciation expense each year. So what this means is, from year 7 to year 10, the depreciation expense will increase to $12,500. In the group financial statement, we must recognize depreciation expense based on the amount the original buyer charged, which is $10,000 in this case. You cannot suddenly increase the depreciation expense to $12,500 just because the holding company transferred the asset to its subsidiary. The difference between the depreciation charge of both companies is $2,500. So the consolidation journal entry for year 7 is debit accumulated depreciation, credit depreciation expense by $2,500. That's the consolidation journal entry for the year of sale. What about 4 years after the sale? For instance, year 8. The standard consolidation journal entry is the one to undo the gain on sale recognized and to revert the cost back to the original amount purchased by the holding company. Just remember that we will debit retained earnings instead of sale of non-current asset. Next, we will revert the depreciation expense and accumulated depreciation back to the amount the holding company will originally charge. But the difference for year 8 is, we need to also account for the undercharged depreciation expense for the previous year. We will debit accumulated depreciation by $5,000, obtained by taking 2 multiplied by $2,500 because it has been 2 years since the asset was sold to the subsidiary. We will credit depreciation expense by $2,500. This is standard as it adjusts only the current year depreciation. Then we will credit retained earnings by the remaining amount. Now, I can understand you probably find this very confusing and very difficult, so I have a tip for you to check whether you have done this correctly. I would suggest you prepare a table stating the subsidiaries records and group figure required for consolidation when it comes to the non-current asset figure, depreciation expense, and accumulated depreciation figure, like this. Then, you can compute the adjustments needed to arrive at the group amount for consolidation. This helps check whether your journal entries have made the correct amount of adjustments. So for instance, when we debit non-current asset by $50,000, we have increased it by $50,000. When we credit depreciation expense by $2,500, we have decreased depreciation expense by $2,500. And when we credit accumulated depreciation by $60,000, then debit it again by $5,000, the net effect is an increase of $55,000. Let's quickly run through the consolidation journal entry for year 9. The consolidation journal entry on undoing the gain on sale and reverting the cost is standard. Next, we will debit accumulated depreciation by $7,500, 3 multiplied by 2,500, because it has been 3 years since the non-current asset was sold to the subsidiary. We will credit depreciation expense by $2,500. This is standard. And finally, credit retained earnings by the remaining amount. Let's do a quick check whether we have done it correctly. The adjustments made to non-current asset is correct. The adjustments made to depreciation expense is correct. And we have adjusted a net decrease of $52,500 for accumulated depreciation, which is also correct. Bolded numbers represent that the figures for the entry will remain the same in any years following the sale. So what changes is only the amount to debit for accumulated depreciation and amount to credit for retained earnings in the second consolidation journal entry, where we will revert the depreciation expense and accumulated depreciation figure.